So over the past week or so, I've done a lot of analysis and spoken with a lot of hedge funds and a lot of big investors and small investors alike that I think are some of the brightest minds out there. And what I wanted to show you here today is really a chart that I think says it all. It's actually a series of charts. But basically what we're going to look at is we're going to look at the way the financial stocks are acting, which represent really kind of like the real economy and the credit loads we have in the markets and the economy, versus the Nasdaq 100. And there's some really telling things here and a couple of trade ideas that I thought I would share here today. So let's have a look at this. First of all, let's have a look at the financials sector of the S&P 500, which just through the lens of a very simple chart, you can see that after a really big drop in the February-March period of this year, we have essentially rebounded back to a lot of technical resistance. Now, the way you want to look at these financials, and you could pull up individual stocks like my alma mater, JP Morgan, and others. And the way you want to look at these stocks is to understand that they essentially represent the real economy, right? In the sense that they are going to, these companies are not the problem right now. Back in 2008, 2009, in the financial crisis, the large banks, some of them went under, as you know, Lehman, Bear Stearns, and the ones even that survived, they had problems. They were basically levered too high. Now it's their clients that are too levered and have problems. So think about your average smaller company. The average Russell 2000 company right now has about twice as much leverage. There's a leverage ratio you can use for that. They have about twice as much debt now as does as they had in 2009. And so these companies have a problem. Also, the consumer is having a problem with a lot of credit card debt and mortgage debt. And even though in the near term there's going to be a situation where some people actually have more money coming in on a monthly basis for the next couple of months than they had with just a regular job, at some point that stops. But nevertheless, some of these banks are now being asked to kind of take a hit indirectly by individual households being basically asked to not pay or told, I guess to some extent, not pay their credit cards, not pay their mortgage and so on for a period of time. So these companies have a problem. These banks have a problem because their clients have a problem, right? The companies themselves, the clients, the banks are well capitalized, at least so far. So if you look at that as the real economy, which I think is going to be a bigger picture bigger problem down the road, and you compare that versus the Nasdaq 100, you start to see a big divergence, and this is where we start to see the trade become interesting. Here what I did is I took the financials ETF, the XLF we just looked at, and I plotted it in orange. I took the Nasdaq 100, the QQQ ETF, in blue, and I kind of just show you here the near-term divergence. So you can see the Nasdaq 100 getting close to back its previous all-time highs versus the financial stocks, which really represent the broader economy. Now, the Microsofts and Facebooks and Amazons and Googles and all those things, these are big good companies, and they do represent the economy, of course, to some extent, but they don't represent sort of the underlying debt problems that we have, right? And so that's the divergence, and I do think ultimately we'll see some mean reversion here, but meaningfully, more importantly, we're gonna have to see some of this stuff come down a bit more as opposed to the financials rallying. Another way of looking at this is through a ratio chart. I'm just trying to show you this in historical perspective. So we've essentially had about, let's call it 4 periods since the year 2000 where the Nasdaq 100 versus the financials has had parabolic rallies. We had it here in the year 2000, or back then in the year 2000. We had it in 2009. We had it again in 2011, and we're having it now. And you could make the argument that now it's even worse than it was before. Not only is it coming from steeper levels, from higher levels, but it's also coming from an already steep incline here. Leading into the year 2000, the incline wasn't nearly as steep. So I think there's a trade to be put on where you go where you go essentially lightly short the Nasdaq 100 and lightly short the financials. So the way we do this is you put on, whether you want to buy a put spread or you want to just buy an inverse ETF, and you say the Nasdaq 100, you want to go a little bit short that, and a little bit short the financials. Now you could do a pairs trade where you could say, okay, I think the financials can hold up better than the Nasdaq 100. But I'm not quite sure that holds up either. So the point is really that both of these things are overbought, which gets me to the second chart, and that might then hopefully make a bit more sense. So this is the chart of JP Morgan. Let me show you this through the lens of a candlestick chart. In full disclosure, I am right now a bit short this stock through the lens of some options trades. And we think there's lower to go there as well, right? So it's not necessarily that we think that the financials are going to rebound versus the Nasdaq 100. It's just that the Nasdaq 100 is probably, through at least a multi-week lens, very overbought. Ultimately, we think that the trend could rally, which is why I'm saying, rather than doing a pairs trade where you would go, say, long the financials and short the Nasdaq 100, I would say go short a little bit of both. Right. So, and I say this, I say a little bit on purpose because I think with the volatility we still have in the market, we have to trade with smaller size. So if there's two parts in the market that I'm right now looking at, and we are marginally short both, it's these two, and that's, and again, not because the Nasdaq 100 these are bad companies. They're not bad. They're great companies, but because of the relative outperformance. Nevertheless, the financials act weak as well, and you can see JP Morgan here basically trying to break out of this technical bear flag formation. So a little bit of short Nasdaq 100, a little bit of short the XLF ETF, maybe JP Morgan, something like that to me makes sense, at least through the lens of the next few weeks, and then we'll kind of see how that plays out. So anyway, hope this helps, folks. We'll see you guys soon.